a stability built on emergency. What if the worst financial disasters in history were not failures of the system, but features of it? Every time markets collapse, governments panic, headlines scream, and ordinary people lose jobs, savings, and homes. And yet, almost like clockwork, the same institutions always survive. The same banks get rescued. The same balance sheets get repaired. And the same voices step forward to say, this was necessary for stability. But here's the mystery most people never question. How can a system that repeatedly crashes be called stable? And more importantly, who profits when crisis becomes policy? Because once you follow the money, not the slogans, you discover something disturbing. Modern financial crises aren't just reacted to, they are monetized. This is the hidden story of how central banks turned emergencies into opportunity, fear into leverage, and collapse into a profit-generating mechanism, while calling it economic stability. What central banks were meant to be. To understand how crisis became a business model, we need to rewind. Central banks were not originally designed to control entire economies. Their early purpose was simple: lend to governments during war, smooth short-term liquidity problems, act as a lender of last resort in rare emergencies. They were meant to be firefighters, not architects. In theory, central banks were neutral referees, above politics, protecting currency value and public trust. In practice, they slowly became something else entirely. The turning point wasn't a single decision. It was a series of crises, and every crisis expanded their power. When money stopped being real. For most of human history, money had limits. Gold, silver, physical scarcity. If governments overspent, they ran out of money. If banks failed, they failed publicly. Then came the 20th century and 2 world wars. To fund massive conflicts, governments borrowed at unprecedented levels. Central banks stepped in to temporarily support national survival. Temporary became permanent. By the mid-1900s, money was no longer just a medium of exchange. It became a policy tool. The final break came when currency was fully detached from gold. From that moment on, money wasn't constrained by reality, only by confidence. And confidence, as central bankers quickly learned, could be managed through crisis as a lever of control. Once money became flexible, something else changed. Crises stopped being catastrophic endings. They became reset buttons. Each crash followed a familiar pattern. Excessive risk builds quietly. Asset prices inflate beyond fundamentals. A trigger causes panic. Markets collapse. Central banks intervene. But the intervention was never neutral. Interest rates were slashed. Liquidity was injected. Bad assets were absorbed. Losses were socialized. Meanwhile, those closest to the financial system recovered first. Crises became moments where wealth didn't disappear, it moved. From the public to the balance sheets of institutions deemed too important to fail. How crashes turn into profit. Here's the part most people miss. Central banks don't directly chase profit like corporations, but their actions create predictable winners. When markets crash, asset prices collapse. Cash holders gain power. Institutions with access to cheap credit buy distressed assets. Who has access to cheap credit during crises? Not households, not small businesses, banks, funds, financial elites. Central banks provide emergency liquidity at near zero cost. That liquidity flows upward into markets, bonds, stocks, and real estate. By the time the public regains confidence, prices are already higher. This is how crisis becomes an investment strategy. When bailouts became normal. There was a time when bailouts were controversial. That time is gone. What was once unthinkable became routine. Failures stopped being punished. Risk stopped being priced honestly. Moral hazard became institutionalized. The message was clear. Profits are private. Losses are public. Stability will always justify intervention. From this moment on, markets were no longer free. They were managed. And management requires shocks, the hidden cost to society. Every intervention has consequences, but they're delayed, sometimes by years. Inflation erodes savings. Asset bubbles widen inequality. Wages lag behind prices. Debt becomes permanent. The public is told this is unfortunate, but necessary. Yet the same pattern repeats. Crashes concentrate ownership. Bailouts preserve power. Recovery favors capital over labor. Stability, it turns out, has a price. And it's not paid by those who design it. Why reforms never work. After every crisis, reforms are promised. New regulations, new safeguards, new oversight, but the core structure remains untouched. Why? Because the system doesn't break accidentally. It breaks predictably. Reforms fix symptoms. They never address incentives. As long as crises justify expansion of monetary power, they will remain essential. The pattern continues. Look around today. Debt levels higher than ever. Markets addicted to stimulus. Institutions dépendent en intervention. Every downturn is met with faster, larger responses. What was once emergency policy is now standard operating procedure. And the more the system depends on it, the harder it becomes to stop. Who benefits from controlled chaos? The real secret isn't that crashes happen. It's that they are survivable for the right people. When volatility is managed, not eliminated, it becomes profitable. And when money can be created to absorb losses, failure loses meaning. This is how crisis stops being feared and starts being priced in. 3 clear takeaways. First, modern financial crises are not random. They are systemic. Second, central banks didn't just respond to instability. They learned to use it. Third, stability, as defined today, prioritizes systems over people. Final warning, and an open question. Every system built on intervention eventually requires bigger interventions. Every safety net stretches until it snaps. The question isn't whether another crisis will come. The real question is, will the next one require more control or expose the limits of it? Call to action. If this changed how you see money, power, and stability, don't forget to like, subscribe, and share this video. Because the most dangerous systems aren't the ones that collapse loudly. They're the ones that survive quietly by convincing everyone that nothing is wrong.